Welcome to Tales of the Tape, where we'll be exploring capital markets by talking to the folks that make it all happen. And if a thread is good, we're going to pull it. No hesitation to head into the weeds on this pod. Now, since this is being produced and distributed by Cboe, a few house cleaning items. The views and opinions expressed by the host and guests of this pod do not necessarily reflect those of Cboe Global Markets and are for informational purposes only. They should not be construed as financial advice. There are risks associated with transacting in all of the financial instruments described herein. It is important for market participants to understand their own risk tolerances. To review all relevant disclosures and disclaimers, visit www.cboe.com/US_disclaimers. By listening to this podcast, you're agreeing to those terms. We're here with Henry, inventor of zero DTE options. That's a joke, but options data guru has been around the industry for a number of years, and I'm not trying to age you, Henry. But before we get into some of what has made options markets so interesting in 2024, I was hoping you could just kind of give us a little bit of a background on how you got to here. Because I know that coincidentally, you started your career as a runner on the Cboe floor.
I did. It's kind of like I've come full circle. Then I actually managed to get a summer internship on the Cboe floor my second year of college. So I was a sophomore. I had no idea what an option was. I begged a friend whose father turned out to be Blair Hull for a job. And he said, you can come to Chicago and maybe you'll figure some things out. And so that was in 87. And I remember getting lost in the loop when they sent me out to get some keys made. Having to find a payphone to call the office and say, I'm not sure where I am. But I spent that summer getting a little bit of an inkling about what options were, but also kind of being, really falling in love with the dynamics of a trading floor. I mean, it was a blast. And when I had started out in computer science at UC San Diego and switched to economics, so I was kind of zooming in a little bit more on business and got an offer after I graduated and came back and became a clerk and, took kind of the standard progression, but was working for a market making firm, spent another year on the Cboe, spent some time on the Amex trading floor, then actually moved to trading in Europe electronically in the early 90s when it was called the DTB, the Deutsche German Börse, was trading DAX options, but they were the first truly electronic exchange. And we got sent over there, a partner of mine, and they said, well, you're going to need to take some computers and you need to tell them if they ask that they're your personal computers, because we basically were smuggling in business computers that weren't actually permitted back in the day. But we set up a little office and traded electronically, and I actually then traded for a year in Paris in French on the last days of the Monep floor of trading the CAC 40, which was pretty hilarious because my French was not very good. And then went to several banks in New York and finished up in 2005 at Bank of America and left and started a data business focused specifically on options. So that really, saying I won't really claim to be an option guru, but I will claim to be a data guru because I've been staring at options data and digging through it for literally almost 20 years at this point. So it's been an awesome journey. And really the funny thing was, for Cboe acquired us in 2020, and it feels like a nice full circle because, I love to be here. We're the biggest exchange. We have the biggest products. We were the original. And it's a great place to be.
I'll have some follow-up questions about Europe maybe at the end, but thinking about U.S. options markets, clearly from that trajectory you've just laid out, what it was like when ADV was a fraction of what it is today. We're filming this in December. There's still some trading days left. However, we do know that we have had the 5th consecutive record year for options volumes. That is already signed, sealed, and delivered. But from your perspective, where you sit, was that surprising to see this continuation? Was it not surprising? Was there some element of it that was particularly unusual?
I mean, I think the explosion in retail volume, when Robinhood pioneered the zero commission universe, that really was a shift because you were taking some major friction out of the process of trading, and also they, besides having zero commissions, they were also targeting a much younger demographic for their account sizes. And so, I mean, over the decade, really from 2010 to 2019, volume was somewhat flat. It was solid. It was like 4 billion contracts a year, but there was not a lot of growth. And there were some years that we were actually down a little bit. And it really was the zero commission started for options in late 2017. It took a little while for people to kind of, realize it. And then COVID, the whole dynamics of, what happened there, people working from home, interest rates going very quickly to zero, a lot of cash being pumped into the U.S. economy, the global economy, that really all kind of combined and then you had the meme stock craze, right? Maybe they're related, or maybe they're just coincident, but the fact that people were at home, and you had sites like Reddit and Discord where people were kind of paying very close attention to some of these massive moves and telling their friends about it, and then learning about, there's call options that are like the stock, but there's convexity and leverage to it, and it really just exploded. I mean, you can look at the data, in 2020, I think the data shows Robinhood was trading about 6 million contracts a day. They were, only a few years old. That has really continued. Actually, I think this last quarter, the data I looked at, they're even slightly above that. So what's been amazing is the growth that came from retail that we'd been waiting for, or I think the industry had been like not sure how to pull in new retail participants, because the big brokers always struggled a little bit with education, right? There's this major fear of recommending an investment, right? And there's obviously options have risk to them. And I think that the brokerage firms were not super duper comfortable with it, some more than others. And so they just kind of ignored that segment. And Robinhood was not afraid of bringing options to the masses. You just kind of had this evolution of how education works. So people are much more comfortable saying, look, here's a trade, here's how it works, here's the P&L, the pros and cons. And that really does get people very comfortable with it. And that wasn't really super common, going back to when there were only, Schwab and some of the other big brokers.
Right. And that makes total sense. And I mean, I feel like as someone that kind of fell backwards into the industry, where it's like, instead of, some sort of progression where economics to equities to then, it's like it was straight to derivatives and like almost not knowing what an underlying was. And so, trying to self-educate while also talking to the people. I mean, there was a lot of just issues with like, is this reliable? Is this even, or do I trust a person that's offering it to me? What's their angle? Do they have an angle? But thinking of how things are changed and from the data side of things, where you sit, there was recently a conference in Chicago, and I was listening to you, and I kind of had this, you mentioned something, and I had the flashback to a different conference around 9 years ago. And, a lot of people were talking, oh my God, we've got so many series out there. We've got at that point, it was getting close to 1 million. Wasn't quite at 1 million. It was 900,000 odd different series. And then you mentioned, now we have 1.7. And it was one of those things where I felt like it was a buzzy topic, and It was kind of like what seemed like the talk of the town kind of just became this big muh and a shrug, and everybody just dealt with it, and markets are booming. Like, what's your take on that? Is there something to be said there? Is it just that people's technological capabilities can adapt, and people are really good at doing these things now?
I think that you definitely had fear for years, like, 1 million contracts to choose from. If you're a trader or retail trader, that's crazy. And if you're a a liquidity provider and you're pumping out quotes, that's a massive amount of kind of load that you have to be able to handle. And then we blew through it in COVID, and you're right, nobody even blinked. I think that what you had was technology kind of got to the point where, you could quote, a million, 1.2, 1.3 million series dynamically, and that it wasn't as hairy a problem as it had been. It's still a very big technological project, which is why kind of we have the universe of market makers we have now tend to be these massive, well-capitalized entities, because it is, the budget to do that is still very high, but it's doable. And I think that, the truth is also because you had this retail wave, you had a lot of, the economics made sense. Like, basically, the new kind of blood coming into the business made everybody's businesses larger. And so, in fact, now I think we actually peak around 1.8 million series into each expiration. It's coming from new listings. It's coming from the daily expirations that have been filled in a handful of products. So, and then that 1.8 million doesn't even include the flex options, which is another big wave we've seen over the last year or so.
I mean, if you throw those in hypothetically, then there's an infinite amount of series, right?
Well,
but
that's what's really interesting, right? Is I do actually think we're kind of, this notion of like fixed expirations and fixed strikes, and you had to have them all there so that people could look at prices. And now basically you have options every day, at least in SPX, and and you have strikes that they go really far down and really far up, but they're $5 increments. Like, I actually think we're kind of getting away from that. Like, and flex options, you can pick any strike you can imagine, and any expiration you want out to, I think, 17 years. And so there is an infinite kind of selection for a portfolio manager, a hedger, not so much for retail, because those flex products are not. There's no retail broker that's come along yet that's opened that up to the retail space, but I actually think we'll probably see that sooner rather than later.
So, I guess like just an extension of how the other products you referenced things are getting more granular, more choice. You can phrase it different ways, but then a step beyond that, how do you get more bespoke? For the listeners that don't know, flex options essentially an options contract with customizable specifications. So if there isn't an expiration on the day you want, you can have a flex contract that expires on that day. If there isn't a strike that you want, you can have a strike created, if you will, for you and this different contract. And then that can trade. So you can almost imagine a world where 20 years from now we're eating potatoes on Mars, and you can every single option is a bespoke kind of deal, hypothetically, right? I mean,
in a way, that's exactly it. It's like when you and I look at like kind of an old-fashioned option chain, right? Like, okay, there's the 60 strikes and the 65 strike and the 70 strikes, and you can kind of, in your head, you can be like, okay, well, this one's priced at 50 cents and the next one's priced at $1. So if there was a strike in the middle, you have a feel for what it would be priced at, right? And if you trade a flex, you'll get exactly what it's priced at. But it's exactly that. You're getting almost a seamless fabric of possibility in terms of whatever strike you want, whatever expiration you want. The volatility is kind of, the implied vol is efficient across them all, which is kind of the important, it's very, very important, because it means that the slippage is very minimal for people that are trading. And that's also one of the reasons we have we see the volume we're seeing, is that the cost to trade is in the hyper liquid products like SPX is virtually, it's almost down to zero. And meaning that, like, it's an amazing environment kind of for the client side. And that's coming from the fact that the liquidity provider side has become so efficient at providing liquidity that they don't need a spread that's 10 or 15 or 20 cents wide.
Yeah, and I think that my impression is also that, like, your retail side of things is probably getting, even if they don't realize it, are getting a little savvier with this kind of like, well, I would expect an option to trade at this, even if they're just trading let's say it's not illiquid. It's just the screen doesn't look super liquid, and you've got a big ass spread. It's 152 or something, right? And you're hopefully you're not just entering a market order, and you're trying to kind of find some sort of fair value for your option, and then maybe you're already kind of thinking that way, where it could lead you to that flex example you're thinking of, where okay, well, if there isn't a 63, but I know 60, I know 65. I can kind of, have this back of the envelope feel for where things are going to be. Yeah.
Well, and technology can help with that, right? So that it's up to kind of the industry and the brokerage community, and even within Cboe, we have services that basically say this is kind of the price that you should expect, and that's your starting point, right? There's it's complicated, right? It has to do with impact and size of everything, but the fact is that you can look at an option you're thinking about trading, and there's a quote there. Maybe the quote's tight, maybe the quote's not so tight, and you can say, well, the theoretical value based on Cboe's modeling, is $1.71. So I'm pretty comfortable bidding $1.70. Maybe you get filled, maybe you don't. It's technology really has solved some of these problems. At the same time, I think it's important for people that are trading, from participants, retail to institutional, to really understand how the market works. That they have to do their homework, because if you do step into a really wide market the wrong way, you can have a bad experience. And we're all working really hard to avoid bad experiences. We know how that works, but the customers also have to do a little bit of homework to.
Well, I mean, I think we've all been guilty of there are plenty of instances when I first started trading where it's very clear that the error came somewhere between the screen and the seat, right? It was my problem and not anybody else's. And I think that's just part of the learning curve. But I mean, to your point about really doing your homework and really getting educated, and the focus, I mean, you go to any conference, everybody's like, we need more education, better dissemination of education. And that there are so many things that, okay, you learn what a call is, you learn what a put is, but there's so much. I mean, there's almost an unending amount of things that you can go into in the options industry, whether you're talking about the instruments themselves or infrastructure that underpins it, which is its own crazy, complicated speed of light. I mean, you see the headlines out there, and there's not really even that much hyperbole. And so thinking of some of those things that are a little bit more maybe not in the public eye, I was hoping to get your take on a lot of the flow that we see hit the tape, but is not really the type of thing you're going to read about in Bloomberg, because perhaps it isn't as cool as the 50-cent VIX call buyer or something along those lines. So, I'm aware that our trading floor in Chicago, which, yes, they still exist, sees a lot of flow in box spreads. And box spreads are just a combination of two spreads that allow you to essentially synthetically replicate an implied rate, either you're lending at or you're borrowing at. I'm sure you can explain this better than I can, but that's a lot of volume in SPX, right? I mean, or I should say not inconsequential. So as these things become slightly easier to execute, I'm not going to say that, a multi-legged large order, and that's what I believe box spreads are almost exclusively a pretty large trade to put on. Can you just fill in some of the blanks for someone that can only explain it to the degree that I just did?
Sure. It's funny. One of my very first jobs, I think probably the second summer, was carding boxes for the guy in SPX, because there'd be an agreed upon price of for a 1,000-point box. You'd say, okay, we're going to pay $999.63, and then you'd actually have to figure out, because this was only trading in fractions, you'd have to use eighths and teenies to get and split the quantities to get the decimal point, and sometimes you needed 4 places after the decimal point. And so we actually, you're using your calculator and you're trying to figure out, wait a second, I need to split it between these two prices and change the volume. But a box spread is simply basically a zero coupon bond, but created in the form of options. So, like I just said, I'm going to buy this thing from you for $999.61. It's a zero coupon bond in terms of the performance, so it will be worth $1,000 at expiration. That is a certainty, because of the fact that it's simply just a long vertical call spread and a long vertical put spread. So if you buy a call spread and a put spread, what you've done is bought the box. And so even back, 35 years ago, traders, and trading firms realize like, okay, well, so if I buy one of these, I'm loaning money out and I'm going to get it back. And there's an interest rate there. And if somebody needed to borrow money, they would sell a box and they know that they're going to have to pay it back at par at the end. But in the meantime, you're borrowing money. So these things continue. These things do trade continuously today. Some of them are huge. Some of them are $100 million in capital changing hands. And you can do one for any expiration that exists. So, we now have, I believe, 70 something expirations in SPX. So a lot of flexibility if you want a 6 month or a 9 month or a 12 month. And then again, you could actually use flex options to get any day that you want out to 17 years. So, boxes are basically a structure, a spread, where options are kind of the instrument you're using, but really the end goal is you want a fixed income investment, and that's exactly what you get. And one thing that's actually, come about recently is Cboe launched the quoted spread book, which allows market makers to actually stream a bid and an offer in boxes as a unit, rather than people having to look at 4 different option prices and kind of do the math, or go into the trading pit, in Chicago and say, hey, what's a December 1,000-point box quoted at? You can actually see it now, and that's a major development because boxes use 2 options that are pretty deep in the money, and a deep in the money option is quoted on the screen pretty wide, just because they're not actually trading actively on their own. And so, we call it the natural market. If you took the bid and the offer of all 4 options and worked it all out, it might be $10 wide. Okay, on this $1,000 instrument. If you look in the quoted spread book, it might be 10 cents wide. And that's because if you actually quoted it out loud, they'd probably make it 10 cents wide. But the fact that that we now kind of permit people, liquidity providers, to quote these things dynamically, where people can just click on what they want to trade and it just trades, that's a game changer. That's relatively new. I mean, that came out this year.
Is it, just because I'm thinking back to your market making days and the technology that has made, QSB possible. Like, if you put on your hat from the B of A days and you're looking to now, like, just totally night and day, or like just a logical extension of where things were. I mean, your background, I'm fascinated by, like how you view now compared to then, especially having sat in all these different seats globally, different instruments.
I don't think it's night and day. I think it's been this evolution. It's in a lot of ways, things are very similar. A customer is interested in doing a trade. They ask a broker. This is on the institutional side. There's a process there to get a price and then get an have some negotiation and get an execution. That hasn't changed at all. What really has changed, and what supports the fact that on a really busy day, we can have 70 million contracts trade. I think we can see 100 million contract day easily. If we get anything, some fireworks, early next year. But it's just been incremental improvements in the market, and it's an incredibly competitive environment, right? There's currently 18 different options exchanged. Cboe operates 4 of them in the U.S. These exchanges are all aggressively kind of innovating and competing to win business and to make their clients happy. And, everybody wants to be able to trade, faster, more efficiently, less friction. And kind of everything that we do is really trying to listen to the clients, the customers, whether they're institutional, pension fund managers or retail brokers that are serving their client base, and say, okay, well, what do you need? And if somebody says, well, we have, about 30 to 40% of the activity is complex orders, okay, spreads, boxes, but also vertical spreads and condors and these other things that people trade all day long. So if that's what people really want to trade and really want to see, then, things like the quoted spread book are a change, and I say it's a game changer in that it really is a big innovation. But really what you're doing is you're taking things that people used to do kind of in an annoyingly manual way, and saying, oh, look, we can make a platform for that, or we can evolve our platform to handle that. And that's what's exactly happened.
So thinking about you mentioning the potentiality for 100 million contract year looking into 2025. What?
100 million contract day.
Sorry. 100 million contract day. That'd be really, that reminds me of the old Norm Macdonald joke, right? Where it's like, today on the New York Stock Exchange, nothing traded. Everybody has what they want, like that would be the same thing. But if we had 100 million contract day, what else would you be unsurprised by in the coming year?
I mean, I think that you have to, if you think at what people really want, what people are using options for is to adjust their exposure to the market and to express some sort of view. And if your view is Tesla's going to go up and IBM's going to go down, you can go make 2 trades on that. You can go kind of figure out what strikes work for that, or the industry can come up with products that kind of help and make that easier to do. And so, currently complex orders, like I said, make up, about 30 to 40% of the activity. Currently complex orders are still all within one stock or one product, right? So if you want to trade an Apple vertical call spread, you can, but there's no such thing as an Apple call against an Intel call. And it's been proposed, and that it's going to take a little while to get kind of everybody, especially regulators, comfortable with it. But people are already doing it anyway, right? If you pull up your platform, or you'll call your broker and say, I want to buy these Apple calls and sell these Intel calls, you can do it. But why do it where you have to kind of basically take a little bit timing risk? So that would be one innovation I think that we'll probably get to.
Kind of like a logical extension to the options world of like a pairs trading tool. I mean, like it makes total sense to your point.
Yeah. So, otherwise, I think that, you see the new products that we've rolled out, that we've kind of taken the universe of, the SPX and VIX ecosystem, right? Which is the dominant, literally makes up about a third of the entire market in terms of dollars. We've expanded that, right, with new variance futures and new options on VIX futures. So like we're broadening things out and trying to kind of pull in more participants who want to trade the kind of products that they need, but also to kind of get this whole, becomes this whole ecosystem, right, where a trade in VIX is hedged with a trade in SPX. And that's, one of the reasons that both of those products get really, really liquid is because the layoff between products works. And so, we're just trying to kind of figure out other places that make sense. And the variance futures are a really good example because that's same kind of risk, but a very different kind of product.
And, again, that when you say things that way, it makes total sense. And it ties into your point about, just kind of this iterative nature of the markets, right? Where, having a single platform where you can, or a single entry ticket, or however you want to think of it, where you can be long the Apple call, but in the same breath be, short the Intel call. It goes back to, you're on the Cboe floor, you're calling your guy on the Chicago Stock Exchange to get the tied order for the shares that you need to right? Mm-hmm. Like it's the same type of thing. You're just eliminating a phone call, right? Like, or you're migrating something from OTC to listed. You're putting something from a securities wrapper into a futures wrapper. Now it's accessible to a global clientele. When we say retail, what do we really mean by retail? Is it global? So it's very logical when I take a step back and look at it from that perspective. But thinking back to the homework and what people need to do, another thing that you'd mentioned recently, contra exercise. And I got burned by this once, so maybe this is more of a personal question, but could you walk through why this can be problematic and why people need to know about it if they're trading, especially close to on an expiration day? And clearly, a lot of that happening.
Yeah, and even, in some cases, it comes into play before expiration too. It's really it's all a feature of the way that American style physically settled options work. Okay, so we're talking about stock options and ETF options, not index options. Those are cash settled, European style in general. But with a stock option or an ETF option, the contract specifications say that if the stock or if the underlying closes above this price, within a penny, I believe is the current limit. If your option is a penny in the money, it will get exercised on your behalf. That it used to be, I think when I started in the business, it was an eighth or a dime, because there was kind of some commissions involved, and if your options turn into stock, then you decide to get out of the stock. It's going to cost you some money. But so contrary exercise instructions are what an option holder can give to their broker and say, I don't want these to be exercised, even though they're more than a penny or more in the money. It gets a little bit hairy, because if you have a stock that expires right at the strike, right, you have $100 call on $100 stock, and it closes at 100. The market, although most stocks close at 4, and most ETFs close at 415, and SPX closes at 415 as well. The world doesn't stop. So if news comes out after the close that is going to take a stock or the entire market one direction, then you have to think about it and go, well, wait a second, those calls that I had that were right at strike and therefore weren't actually going to get assigned or automatically exercised. If the market goes up, and usually you can see that in the futures or in after-hours stock trading, then I do want to exercise those calls, because even though the stock closed at 100, it's now trading at 150 cents. Okay, whether it really is trading at that, or whether you have to infer that from the futures or similar stocks, like that's where it gets tricky. And I do worry sometimes that the retail community doesn't quite understand that part of it. I think that we've done a great job. Retail investors generally know how options behave, right? Delta, depending on which way the underlying moves, how time is going to impact it, volatility, everything else. But when you get into that last moment, it can get a little bit confusing, and then it gets even worse if a client has on a complex order, so they're long one leg and short another leg, and if the stock is making a big move after hours, it's possible that both legs are now in the money, or it's possible that one is and one isn't. And so it's one of the reasons that that index options are just so much simpler, because it doesn't actually matter if the market moves after the close. Index options settle into the settlement price, which is basically the close. Everybody knows with certainty this is done. There's a cash settlement, and that's the end. So, and this contrary exercise, my example was using like a pinning situation where it's right at the strike, but it's one of the reasons that short-term options on single stocks are really controversial. Okay, we don't have any dailies on single stocks currently, but there's weeklies on lots and lots of liquid stocks, and those expire every Friday. Now, earnings don't usually come out on a Friday, but things do happen after the close on Friday. So there's this contrary exercise window, is what it's called, is a certain amount of time after the close. I believe the rules are it's about an hour, but different brokers get to kind of handle things a little bit differently. It's everybody's job, but probably primarily the broker's job, to make sure the customers understand how the contrary exercise works, make sure that they have easy access to basically to give contrary exercise instructions, maybe to change those contrary exercise instructions, because if the stock runs up and you say, okay, yeah, I'm going to exercise those calls, and then the stock runs back down, you might change your mind. And so the contrary exercise is a tricky kind of bit of how American style physically settled options work. And I was saying it doesn't have to wait until right at that expiration moment, because you have situations with dividends or deep in the money options that might actually get exercised early. And it can be a surprise to a customer. You'd be like, wait, I got assigned on some of these? Like, they don't expire for another 2 weeks. And your broker's like, well, yeah, now you're long the stock. And you have to make sure that you have the capital to carry that stock. And it can be a very rude awakening when something happens and you weren't you didn't even understand it was possible. because people can have a bad experience. They can lose money in that case.
We're kind of approaching time, but since I have you, and we're being recorded, any other stuff that's on your, I always like to ask, like, what do people not ask you about that you wish people asked you about? What's not in the headlines that you think is criminally underrated, or, things of that nature?
Good question. I mean, the things that I'm kind of most excited about is, what I see in our markets is this incredibly efficient ability to get in and get out of trades, meaning you're really not getting screwed getting in and screwed getting out. Okay. In general, it's a very smooth process where it's very reasonable. In fact, like compare, if you look at the bid offer spread and you might have to be a little bit careful and say, well, there's a quoted spread and there's a traded spread, and you need to understand the difference there. But the amount of kind of capital that you can put to work or hedge very, very easily is it's an amazing thing. It's a very, very easy process. Instantaneous executions. In the olden days, you'd wait 30 seconds to see if you got any, and then magically, oftentimes, oh, sorry, it moved away from you, right as the broker got to the pit. So, I think that I think technology is making all these amazing things possible. Like even we were playing around with some of the ChatGPT stuff before the show. It's like that is becoming a way that people accomplish some tasks, and it fits right into the trading world. And if you say, listen, I'm interested in a trade that will behave, that will express my view that this is what's going to happen for the next couple months across these different sectors or these different products, what kind of trade would be the most efficient way to put a limited amount of capital to work on that? And technology can tell you, here's the trade. Technology can do the math and say, this is exactly the kind of the risk reward and probability profile. And then you can use technology to help you keep this trade kind of in balance if it's the kind of trade that is going to shift depending on how things move. And that's really pretty amazing. Even when we when Cboe Labs talks about dispersion, right? That we have this dispersion index, and dispersion is a trade that institutions like to do, but it's just becoming easier to see and get in and get out of these trades. That used to be, just so hard to. It almost was like a little club. You had to be, a French quant to understand what this trade was. It's now much more accessible. So I think that makes me pretty excited. And then I'll tell you, this explosion in ETFs that use options to get certain kinds of exposure, whether it's a buffer or whether it's a yield component. This is all brand new, and that is exponentially exploding in terms of how many products are out there, and it gives customers, or investors an option, a possibility, but it also gives everybody else or everybody's kind of the ability to dig around. And so, I was looking at some of these levered MicroStrategy.
You took the words right out of my mouth. I was gonna bring up some of the levered ETPs.
Yeah, I mean, there's pros and there's cons and there's haters, but to be able to kind of try to make sense of it, take it all apart, say, okay, I understand what they're doing here, and you can actually see in those products they generally have to publish their holdings, so you can actually go see what they have on and try to figure out if you like it, if you hate it. There's a way to use options in many cases to bet against the product if that's what you want to do. So there's a lot of innovation and kind of just really neat things going on in the product creation space, and it's only possible because of the fact that the options are so efficient and easy to trade, because you can't have a structured product or an ETF if the options market that is a major part of it, if not the entire thing, is too difficult or too inefficient to trade.
And the funny thing about, I'm not sure if this is required by the regulators, but not only will it disclose the swap, because I know frequently it is a swap that's underpinning some of those levered ETPs, you can actually see the counterparty. which I don't know. I find that interesting. Just like, oh, who did these issuers, like know who's their prime. Anyway,
Yeah.
And then there are the ones that I always like to check. Are you using some options? Because I also know because these levered ETPs have kind of, just are so prevalent, and there's new ones coming out all the time, that a lot of these single stock ones, the swap dealers don't want to put more than a certain amount of capital into the, for a single name, and all of a sudden they've got $1 billion swap or something. I've heard that it can be a little bit of a non-starter, that there's these capacity constraints. And so maybe there'll be those that are actually then using options somehow to then get that exposure. And then there's the options on the levered ETPs.
Mm-hmm. Yes, it gets very kind of meta in terms of like, this is what this structure, this is what this product does. It's using options, and now you can trade options on that product, which is using options. But I mean, I think that it gives people that are interested in derivatives and finance something to dig into. The transparency, I think, is really, really good, and so you can see it. You can even, using some of our platforms, you can find the trades that these ETPs have in their book, and you go, look at that. He's this structure is long 812 of these calls, and then like you can find the 812 lot in time and sales using live vol or trade alert, and be like, okay, that's the price they paid, and you can see all the Greeks on it, and it all kind of makes sense because it all comes together.
I mean, I tell people, if you have any bit of your personality that is like hyper curious, or you like kind of deconstructing, decomposing, or doing some kind of sleuthing to like, reveal some answer, I mean, you can't do much better than derivatives, like I don't think there's much close. Well, we've already run over a little bit. Okay. Henry, thank you for being the guinea pig on the inaugural episode of Tales of the Tape.